Loan officer training with the mortgage calculator. We will get started here in just a minute. We are going to wait just a couple of minutes to go live. We are streaming this live on Facebook and LinkedIn and YouTube. So give us a sec to go live on all the different platforms and give everybody a chance to jump on here. Now, I see there were already people there in the comments. Feel free to drop a comment as you tune in. Thank you for the comments, though. Leonardo, Sonara, Cressida, Nicole, Winston, Christina, Sandra, John, Gloria, Arjun, Oscar. Thank you, everybody, for the comments. Anybody just tuning in, feel free to drop a comment there. Appreciate everybody tuning in early. We'll get started here in just a moment. Great topic here for today. We actually touched on it on our daily rates live show today that we do at 11 a.m. Eastern every day, where we go through some live rates and then do a deep dive into a different topic. So that was today, and now we're going to go further into it from a loan officer training standpoint here today. That being said, looks like we are live on all the different platforms, so we can go ahead and get it started. We'll take the chat off the screen here. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And every Tuesday and Wednesday evening at 7 p.m. Eastern, we do these loan officer trainings. Every week, we pick a different topic. And our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, does a deep dive into that topic. So I know he has a presentation to pull up for us here today. And today we're going to be talking about working with renovation loans. So with that being said, I will turn it over to Jose to give us some knowledge on this topic.
Good evening or good afternoon, everybody, depending on where you are, because as you know, the Mortgage Calculator has loan officers all over the continental United States. I don't think we have anybody in Hawaii just yet, but we are growing. Renovation loans are a very great tool to have in your arsenal in this time of very competitive. It's a very competitive environment for listings, for properties. So we have to get creative to try to increase our options. Now, before I get a little bit more on that opportunity, I will state renovation loans are not fix and flip loans, nor fix and hold loans, which are bridge loans for investment properties only that are for the purpose of either acquiring the property, fixing it, and selling it for a profit, or acquiring the property, fixing it, and renting it, keeping it as a rental property. The fixed flip loans are a totally different product which does not use the personal income of the borrower and close in an entity, and we would consider those business purpose loans. Now, we do have renovation loans that do allow for an investment property on the conventional side of the scheme, but the purpose of renovation loans really is to help out housing, right, in general, for our primary second homes, or for an investor that's going to build it for somebody to buy it. But it's not the fixed flip mentality, right? Renovation loans are full term loans. They're not bridge loans. So, what renovation loans allow us to offer to our borrower is more opportunities to purchase homes. For example, if they previously would not be able to buy a foreclosed property because it's a cash only transaction, so they would be limited from being able to participate in that pool of homes for sale. With the renovation loan, your borrower can purchase a property with condition related items and can close with financing, right? So a lot of those foreclosures that may be out there, well, there's really not that many out there, but those that may be out there, this would allow your borrower to close on it. Or, for example, as you guys know, that show Love It or Listed, I think it's called, where they're showing properties and they got to decide if they're going to buy one of the new properties or if they're going to keep theirs. Well, this is one of the scenarios that would allow you to keep yours and make it your dream home, because renovation loans do also allow you to refinance your existing property instead of sell it. If it's dated kitchen, dated bath, need new windows, ACs, whatever it is, the renovation loan will allow you to do that. We do have limited renovation loans and we do have standard renovation loans. So, what exactly is a renovation loan? Like I was stating, a full term, I state full term, different than the bridge loan mortgage that allows including renovation costs along with the purchase costs if it is a purchase. But you are allowed in most of the renovation channels to do a refinance, right? So we have options that are conventional Fannie and Freddie options, and we have options that are FHA, 203K, streamline option, and regular option, which I'll get into more detail when I get into each of those categories. We do have VA renovation options, and we do have USDA renovation options. So, again, it's just very important to note. Uh, what the renovation loan is so you don't get confused when discussing it with your borrower, as it is a full term loan, not a fixed flip loan. And it is a great option for purchasing properties with condition issues that would not be possible with regular financing. So let's give a moment. There you go. So I'll let you all check that slide out for a minute on what the renovation loan is. Let's go now right into the meat and potatoes of the matter. Now, who qualifies for for a renovation loan? Well, due to the nature that a renovation loan is basically an agency product, like I mentioned, it's basically going to be conventional Fannie and Freddie. It's going to be VA, FHA, or USDA. You basically have to be either a US citizen, right? A permanent resident alien, basically, you have your green card, or a non permanent resident alien with US credit. As we all like to state in all of our presentations, what a non permanent resident alien is. So, to not confuse anyone out there, it is a borrower who is working here, living here. They do not have their legal status like the green card, but they do have legal status to be working here. They have a certain type of visas. There's a couple of different visa types that allow the borrowers to live here on a full-time basis and work here, legally work here, a W-2 type job, right? And as long as that borrower has that active visa, it has US based credit and verifiable income that would be verified the same manner that we'd verify any other national based borrower. They are eligible for any of the agency loan products. Now, obviously, I would ask you to check with your sources and check your guidelines to make sure, because sometimes some investors do add overlays for certain visa types and certain residency types, like a DACA visa, for example. So I do ask you to look into those and make sure that the route that you're choosing is applicable. But as far as the overall agencies, they do allow it. So obviously, as is with all agency loans, entity vesting is not allowed. So in the few cases where we do allow an investment borrower on a renovation loan, they have to be taking title in a personal name. So again, this is eligible for primary, second home, or investment loans. Now, the real important thing to note in all of these renovation loan types is that you always need to use a contractor. So those of you out there that think, okay, this is my chance to do the deal and squeeze more out of it because I'm a contractor, so I'm going to save money, I'm going to get more bang for my buck. Nope, sorry, not possible. For all of these renovation loans, the same as for the one-time close, which is not a renovation loan, but it is a construction loan, agency construction loan. They do not allow self builds and they do not allow self help. That means that you got to use a contractor, and your contractor has to be good at doing these types of projects because the upfront work does require some tedious paperwork. They really got to dot their I's, cross their T's. They can't give you that estimate on a napkin type of deal or like a one line estimate. They really got to break it down. There are forms specific to each loan types, and they do require a breakdown, the cost, the profit, overhead, all that kind of stuff has to be laid out when you're doing these types of loans. So that's why probably one of the most important steps is the upfront work in, just setting up the loan, right? With the proper contractor that has all the licensing and the experience that these programs will require, because there are, and whenever you get into these projects, they don't want a contractor that's going to disappear halfway through the project and leave the borrower holding an empty bag. That would really be a bad trick. So let's get into some of the specific types, right? Our first type of loan would be our conventional renovation loan, which does allow for purchase and refinance as well, right? Now, keep in mind, the refinance component is going to be the repairs, right? That's going to be the cashing out kind of deal, the repairs. So credit scores as low as 620. Now, the conventional option does offer the greatest flexibility as far as property type. So if you ask yourself, why would you do one over the other? Well, one of the specific reasons that you would probably want to do the conventional one is if, for example, you're doing a 3 or a 4 unit, because this option does allow 1 to 4 unit primary residence, does allow for second homes, does allow for a 1 unit investment. Now, they don't want the investors to get crazy with the 2, 3, or 4 unit. This is not a renovation hack, but they will allow the 1 unit investment property. They will also allow a manufactured home and a condo. So you see, this one has the widest spectrum of eligible properties. Now, the loan can be used, and this is pretty cool about it. The loan can be used to cover the cost of plans, closing costs, up to 6 months of interest, PITI, basically on the loan, permits, the contingency reserve, outdoor structures used for leisure, such as a deck or a pool, because some of the other options don't allow things like that, but this one does. And another cool feature is that it can include renovation to an ADU, including a manufactured home ADU. We got people out there that their ADU is they got a big lot, they got the main structure, and in the back they got a manufactured home. Well, you can use it for that, right? Some of the other options, you can't use it for anything that would be considered an income producing component, but the conventional renovation loan option does. Now, what you cannot use it for, and you're going to find this pretty common in most of the other options, you cannot use it for raising an existing structure, raising as an RAZING, meaning like take it all down and leave it just to the foundation, for example, you're going to use it for raising an existing structure and building a new primary dwelling unit. It's not for that. That's a construction loan, not a renovation loan. And it cannot be used for any personal property. The only exception to that is if you want to get new appliances, because you need those pretty much to live, right? You need a fridge, you need a range, you may want a dishwasher, you may want a microwave, ice maker, maybe a wine cooler, but that's about as far as you can go with personal property.
All of the add-ons that you're going to discuss, no matter what type it is, the one thing is just because you want it doesn't mean you can put it in the scope. So you just want to talk about that it has to work in the scope, no matter what it is. Because a pool might cost $100,000 and only add $50,000 in value, and that would put it out of scope in order to add a pool to most homes a lot of times. So I just want to make sure that just because you can doesn't mean you can't.
Well, absolutely. I'm glad you brought that up because one of the things you have to be aware with the renovation loan, and this is across the board, all of them, they do require a certain appraisal, an ARV appraisal, which is going to take into consideration, excuse me, the as-is value of the property, of the home, then the repairs, which is going to be, the scope of the repairs, and you do have to provide the appraiser with the estimate, right? They need to have all that stuff. The appraiser needs to know exactly what is going to get done to that property to the T. That's why the upfront planning on these deals is so important. When you get to the appraisal phase, all of that has already been, set up. So the appraiser is going to include in the appraisal the scope of the repairs, including the cost, and then they're going to look for comparables and provide an after repaired value, also known as ARV, as in Victor, right? And that's what Nick was mentioning. You could put that $100,000 pool in there, and it may only add, it's hard to say what it's really going to add, because what it's going to boil down to is they're going to have to find comparables in your neighborhood with a pool. And it's the same requirements for all appraisals. You need proximity to the subject, right? Once you go further out than a mile, then you go to 2 miles, the appraiser is going to have to get pretty creative in their comments. And if you got to go out further than 2 miles, and then you got to go 3 miles to look for a home with a pool, there it's going to be a pretty tough situation. And at that point, if the add-on value to the pool is really going to be diminishing there. And if they can't find any within the proximity that they need, then they're going to resort to adding a value for the pool. And then you're going to really be stuck, because they're not going to put $100,000, and you'd be lucky if they even put $50,000. In most cases, when we're looking at pools, you're looking at $10,000-$15,000 adjustment on an appraisal for a home with and without a pool. Right. So you got to really be careful of what you're doing. Reach out to, your real estate consultants out there, have them make sure that you have comparables for, recently remodeled homes within close proximity of the subject, because that's the value you're going to be shooting for. You're going to be looking at the gross living area has to be similar. The age of the home has to be similar. Now it's going to be remodeled, so hopefully they'll have some remodeled comps. But what happens if you don't have recently remodeled comps in the neighborhood, and yours is the best one, the over improved one? You're going to be stuck. You may not have an ARV that would hold the repairs that you're doing. So that's a really important point that Nick brought up there. Now, our FHA 203K option is very good for purchase and rate and term refinance. Again, they're talking rate and term refinance because there's not a cash out component. It's going to be the rehab is going to be the where you're going to get the extra money for. So you have a standard option and you have a streamline option. The standard 203K option has a minimum $5,000 loan amount. Now, I don't know why anyone would use a 203K loan If it's only $5,000, you're better off putting it on a credit card, believe me, and just forgetting about all the paperwork and the bureaucracy that's going to be involved with the loan, right? But you never know. But the standard option does require the use of a HUD consultant. Now, another reason why you would not want to use a standard option on any loan amounts, on any repair amounts of $35,000 and below, is because at $35,000 and below, you're not required to use the HUD consultant, right? And why could that be an issue? Because let's say you have the scope of the work, right? It all looks good. You got it budgeted perfectly, $34,985.70, right? The HUD consultant comes with this pad and starts looking at like habitability items and notices, oh, you got some locks that aren't up to our code. Oh, I don't know, that wiring looks a little suspect there. I don't know about this. Next thing you know, they're adding $5, $6, $7,000 to the project. So now, what are you going to do? Right now, you got to increase your loan. Well, I mean, excuse me. Let me back up a second. If you're under 35,000, you're fine, not using the HUD consultant. But if the HUD consultant comes in, you already have your budget, and let's say you're maxed out with your DTI, and they come up and they bring up a whole series of additional items that you need. Now you got to look at, oh my God, I don't qualify for an extra $10,000 or $15,000 in loan. So now you got to take away some of the items that you wanted and have to include the items that are required by the HUD consultant. So keep in mind when that is going on, or what may happen with that, and what are the pitfalls besides the extra cost of the HUD consultant, anywhere from $750 to $1,000, just to have that person come and go through the property and provide their report. Now on this type product, it is minimum 580 credit score, which is usually going to be around the area that most FHA loans give you an AUS approval. But even if you had a scenario where you were at a lower LTV and could get the AUS approval below 580, usually this product is 580 minimum, because there is some risk associated with this loan. In essence, you may not finish the repairs and they may be stuck with this property, so they feel it's risky enough taking you down to a 580 credit score. So like I mentioned, this is for rate and term type refinances, no cash back. Like I mentioned previously, also, you must use a contractor. And like in all of these other loan types for renovation, the contractor and the borrower cannot be related. So you can't use your uncle, your grandfather, your brother, sister, and uncle. You can. There cannot be any relation between the contractor and the borrower. Now, another really important point to note is that the property must be an existing property, must have been completed for at least 1 year before the case number is assigned. So if it can't be brand new construction, for example, that you're going to do this to. You got to have, it has to have existed at least 1 year. Like in the other conventional option, you cannot demo the existing structure down to the foundation to rebuild, right? They don't even really want you doing too many structural things, but at least not on the $35,000 option. But they definitely don't want you to take it down to the foundation and rebuild. Now, in eligible property types, now this is for primary residences only. Now, what's nice here is they do allow a 1 to 4 unit. So another reason why you may want to consider the FHA one is it allows 1 to 4 unit properties. The VA and USDA will not, as you will see. Does allow manufactured housing, FHA approved condos, but obviously only the interior, right? I mean, why would you want to do anything outside of the interior? But they note that existing structures only. And another very interesting point, I guess this goes in line with allowing 1 to 4 units, is they do allow for the renovation of an existing ADU. Now, that does not mean you can build an ADU because it has to be an existing structure, remember? But you can renovate an ADU. So that's a nice feature because that's very important for many people as costs and expenses have been increasing. People are looking for that ADU to provide additional income. Now, our USDA renovation purchase does have, now this is the renovation loan on USDA is for purchase only. There is a repair escrow option, which I will show next after this one, that does allow for refinance. But the renovation one, which is the one that allows a larger scope for repairs, is only for purchases. Again, credit scores as low as 580 with at least 2 credit scores. No minimum repair costs for non-structural items. If you go above $35,000 in the budget, you are required to use a HUD consultant. You're going to see some similarities here. Now, here's what I was talking about. This one is only eligible for a 1-unit single family residence or a PUD. A PUD meaning a 1-unit property that's in a community, deed restricted community, homeowners association type stuff. No relation with your contractor, who is a requirement. You got to use the contractor. You cannot demo the house down to the foundation. Now, another real interesting point here, the limited option, which has the $35,000 limit, does require the home to be habitable. Whereas the FHA option does allow, even on the streamline option, the home can be not habitable, but USDA is a little bit different. In their limited option, the home is required to be habitable and non-structural repairs only. Now, the standard option, which does allow you to do structural repairs, also allows you to collect up to 6 months PITI. Now, what are some of the eligible repairs for USDA? Because, they tend to be a little bit more strict. Well, you're talking about removing safety hazards, adding disability access to the property, repairs and installation of septic and well systems, additions or structural alteration, which is pretty cool there now. Just, it can't be an ADU, but it can be an addition to the home or structural alteration. Modernization of the kitchen, bath, interior flooring, siding, and repairs of existing pools. But it has to be an existing pool because they do not allow a new pool. They do not allow repairs to manufactured homes, no repairs to condos, no converting structures to a single family home. For example, a barn can't convert a barn to a single family home. No alterations to provide any income producing features, no installation of luxury items. So you can see how USDA, they're trying to keep it simple and stay to the purpose of what USDA loans are really for. Remember, USDA loans are meant to service our agricultural community and allow them to own homes in communities where they usually have a little bit lower income. Now, our repair escrow option does allow for purchase and a rate and term refinance with a repair escrow. Now, this is pretty cool because this is the only program out there that actually allows a repair escrow, but it's very similar to an FHA 203K streamline. Basically, they just call it repair escrow. Same minimum 580 credit scores. Now, the catch to this program, the repairs are limited to 10% of the loan amount and must be completed within 180 days. So most of these programs require 180 days or less, 6 months or less for the repairs. But in this case, they limit the repairs to 10% of the loan amount. So it's a $150,000 loan, $15,000 max. But at the same time, if it's a $500,000 loan, That's 50,000. So that's better than the FHA 203K. Again, they're a little strict with the eligible properties, a 1 unit, but in this case, they do allow for the condo and they do allow for new or existing manufactured home, because since this is like it's sort of like a limited option, I guess, for USDA. So they do allow for the property types that they do not allow for the other ones. But they do not allow foundation or structure repairs, electrical and plumbing. So there's a lot of stuff right there that they've eliminated, right? For that, they want you to go to the full option. And the other real important point here, the home needs to be habitable. Again, it cannot be an uninhabitable home like the 203K allows. So the same way as the regular USDA renovation loan requires a home to be habitable, so does this one. And you have to use a contractor. And again, keeping in line with the fact that they do not really want this for investment or any investment related type component, renovation or construction of an ADU is not permitted. And then last but not least, we have our VA purchase. And then VA also calls their refinance a cash out, because the only refi that VA does not call a cash out is the Earl refinance, right? So with VA, refinances are always referred to as cash out. So again, minimum 580 credit score. VA does allow 100% LTV on both these options, but be aware that some of the investors do and lenders do put overlays on VA on the refinance and limit it to 90%, but the VA guidelines allow for 100% LTV. No minimum repair amount, but repairs above 50%, excuse me, $50,000 do require a HUD consultant. And repairs above $200,000 require second level project review. Like the other renovation projects, they cannot be used for a complete tear down to the foundation and rebuild. And here, eligible properties are only primary in nature, no second homes, no investment, 1 unit, 2 unit, and manufactured homes. And they are a little bit, they don't give too much guidance on the eligible repairs, but it's more on the ineligible. But some of the examples they give of eligible repairs are structural renovations to the interior, adding a second story to the property, but that would require a second level review, adding a private water system, repairs, renovations, and repairs and renovations to the home, they'll have to be common to the area. So they do not want you to do something super unique to your home and make your home like something that you're not going to find in the neighborhood. They will be looking at that. So the guidance you can look here towards what you can't do, I think, is probably what would limit you. Because if they let you go, in such high dollar amounts, you know, they just got to approve it. That's basically it. But what they definitely will not let you do is, for example, repairs or removal or installation of oil tanks, private waste systems, mold remediation, or any repairs that make the home inhabitable. Because one of the catches on the VA home also is that it has to be habitable. So that's a catch 22 on the scope of your project. No self help, and you need a contractor, right? So that's what they mean by no self help. Self help is when you think you're going to do it yourself. So, but I may back up to that point about habitability, is that if the home is habitable, you cannot make it inhabitable. That's what it boils down to. But if the home is inhabitable from the beginning, you can use your repairs to make it habitable. But you cannot go in the opposite direction and have to leave the home if you were living there previously.
So that's it for slide.
Yes, sir.
All right.
Those are our four types, which are conventional, are FHA, USDA, and VA in terms of renovation loans. Because non-QM doesn't offer these. In the anything in that realm would be our fixed flip loans.
I don't see any questions on the products really. A couple people said it was blurry. Sometimes the internet's a little flaky, so you can always rewatch it and see better text. And if you're on our team, Jose posts some of these guides as well, so feel free to ask. But if we don't have any questions, I guess we'll go ahead and wrap it up. So thanks everybody for joining us. We do these loan officer trainings every Tuesday and Wednesday at 7 p.m. Eastern. And tomorrow we will continue this renovation loan series with some actual structure of some deals with some live quotes, live numbers, like we do every Wednesday. So join us tomorrow, 7 p.m. Eastern. Thank you, Jose, and we'll catch everybody tomorrow. Thank you.
Thank you, everybody. Have a good night.